It's nice to be amidst a student. As we have been talking on financial inclusion and financial literacy, there are different domains in the financial landscape. We have got banks. In the banks, there are different segments, and then capital market players. Then one more of that is the non-banking finance companies. I'll just give some idea about these non-banking finance companies. They are all, to begin with, they were of different forms, different legal structures, and they were trying to lend money to the borrowers. That's all. But one thing they were doing is they were collecting deposits. And the rate of interest they charged were not subject to any kind of regulations. And there was no discipline on the deposits which they were accepting. And this resulted in huge problem in the sector. And the deposits collected were invested in different avenues, speculative avenues, and ultimately the depositors started losing money, and the losses were quite substantial. And when suddenly these losses aggregated, number of units, companies which are failing increased, the regulator stepped in. And then they started restructuring the whole segment of non-banking finance companies. The word non-banking finance company, many times I myself wondered, though I was running the department. They could have called finance companies also. Non-banking, see, they do not undertake the core functions of banking. That's the only issue about it. To identify them, they are called as non-banking finance companies. They do not come under the regulation of banking, and there is a separate regulatory aspects for that. Now, over the period of time when they started regulating them, the whole issue was very simple. How to protect the interest of the depositors. That is a key regulation. If you want to regulate, you want to protect the interest of the depositors, the basic thing is that the institution which is accepting the deposit must be financially strong. And not only financially strong at one point of time, it must be sustained over a period of time so that the depositors' money are intact. This is the basic theme which we adopted in regulating the non-banking finance companies. The first step we started was they must all be registered with the Reserve Bank of India. If you are not registered, you cannot be in the business domain. And once this registration started, we weeded out hundreds, rather thousands of companies, and the numbers came down. And then wherever they were accepting deposits, we put conditions on that as to how much deposits they can accept. And they were subject to inspections. And slowly, we started giving registration for new companies with the condition they cannot accept any more deposits. So there came a system where companies which can deposit and continue, but no more new deposit accepting companies. So we segmented it. And we allowed it that, and we are monitoring only the deposit taking companies. There was no regulation, much regulation for non-deposit taking companies. But they started growing in size. They were accepting money in different forms. They were borrowing from banks. They were floating debentures. They were borrowing from other companies. They were going to the market to borrow. In other words, the public money was coming to them in different forms. Debentures, bank borrowing, bank money is public money. So the idea was that unless these financial institutions are sound enough, the lenders to them, whose money is basically from the public, cannot be strong. And therefore, we started regulating even the non-deposit taking companies. What exactly the regulations we try to do? The regulations we tried to do was that they must have adequate capital, first. Second, they must have prudential norms for the assets they are having. And then we said there must be what is known as corporate governance. Since it is student, I want to make it much simpler. Corporate governance means a disciplined way of running the organization. It cannot be haphazard. It should be subject to some norm, rules and regulations. And then we also imposed conditions that they must submit periodical returns to the Reserve Bank of India. And in the assets, they must keep monitoring and reporting to us there is weakness. They must make provisions for that. In other words, slowly we started expanding the regulations for even non-deposit taking companies so that the financial system is not contaminated by weak companies. And those companies which are weak enough, Reserve Bank was not very keen on them to continue in the business. And then the number of companies being very large, we found that too much of regulations hampers the functioning of these companies independent of the size of that. So if there is a small company with 100 crores business and there is a company with 10,000 crore business, when you apply the same norms and provision, the small companies suffer. They cannot afford. Cost of regulation becomes more. And the risk to the system is not much. And we are not allowing them to accept deposits. Therefore, what we did was, we classified them as two segments, systemically important deposit taking companies and systemically not important companies. We segregated them also. So, came into picture deposits taking companies, systemically important companies and non-systemically important companies. And with these non-systemic, non-banking companies were subject to lighter regulations, not very rigorous regulation as in the case of systemically important companies. And even in these companies, we started classifying them. Those will have public interface and those do not have customer interface. And then those have borrowings and they don't have public funds. So we have adopted a standard or method, the Reserve Bank adopted a method where apply the regulation depending upon the institution and not simply same for all. So this has facilitated easy functioning of that. But at the same time, the public interest has been safeguarded with reducing their deposit taking activities. The recent framework, Reserve Bank has said even the number of times they can accept deposit has been reduced. And this is in the backdrop of the Reserve Bank's pronounced policy that deposit accepting activity must be confined only to the banks and no other institution should be allowed to accept deposit. This is the regulator's view. And therefore, today you can safely say that non-banking finance companies are much more safer and financially sound and they do not pose threat to the depositors. The amount of deposits non-banking finance companies are holding is very, very limited and therefore, starting from losing of money by substantial number of people, today NBFCs have migrated to a point where they are quite safe and no depositors will be allowed to lose money. The second thing is, it was an unregulated domain, but today it is very much regulated. And the third one is, depending upon the size of that, the regulations are lighter or harder. And therefore, we have now got a clean system, so much so, you find there is a lot of interest shown by overseas investors to to invest in these companies. We have provisions where there are a number of companies where foreign investors are holding stakes in that. And you can understand today that moving away from unregulated, rampant system to a very orderly and regulated system is a Herculean job, which the Reserve Bank has done over a period of, very short period of a decade. And this is the story of the evolution of the non-banking finance companies. Now, the advantage, why non-banking finance companies are very important in the sense, they are one of the important credit delivery channel. That means a credit purveyor, credit giver, apart from the banks. If you go into a commercial bank even today, despite all the talks we make, getting a loan from a commercial bank is not an easy job. It's very, very difficult for different reasons. Not that they are wrong, for different reasons. But these non-banking finance companies are ready to take much higher risk than what normally a commercial bank is ready to take. And therefore, the credit availability becomes much more faster, not easier, much more faster. What they can, in some of the non-banking finance companies, if you see, they offer the credit in a matter of 4 days, 5 days, whether it's small loans or big loans. They give very fast. But the conditions are quite rigorous, and the rate of interest they charge may be slightly higher. There are no specific interest rate regulation for non-banking finance companies, unlike the commercial banks. Nevertheless, you find with the competition, the non-banking finance companies' rate of interest is all equally competitive, if not as good as commercial banks. And non-banking finance companies, the size of the assets are quite large. I mean, they say it's growing at 20% on an average, unlike the commercial banks, which their growth is faltering now, the past 1 or 2 years. And the domains in which they are lending has widened. They fund infrastructure, they fund retail, they finance SME. There is no area where they have not entered. And currently, the statistics reveal their presence in the retail market and SME segment is increasing. In other words, you can say NBFC is effectively started increasing their contribution towards financial inclusion. Retail sales, retail segment is a very important area where commercial bank retail segment getting the loan is quite difficult. And NBFCs have started SME sector in a very big way, and they are increasing their share. And now you cannot dispense them so easily as a dispensable segment. They are contributing significantly for this financial inclusion. In this context, 1 or 2 lending portfolios are there. If I tell you, you will appreciate their contribution. One area where they are dominant is financing the transport vehicles. Not only they finance new transport vehicles, but also they finance second-hand transport vehicle, single transport operator, 2 or 3. And this is a very, very important area to develop transport network in the rural and urban sectors, both. The other area where these NBFCs have taken a lead role is microfinance activity. As you know, microfinance is basically, the idea is to lend for the very small size loans to the villagers and rural sectors, small micro industries like that. And here they have done a great work by extending their presence across the country, and the number of clients they are having huge. And the contribution has been so significant. When Reserve Bank of India coined the idea of floating small banks, almost all the licenses Reserve Bank gave is to these microfinance companies. Now, many of these microfinance companies have now converted themselves into small banking, small bank finance, and they continue to do what exactly they were doing earlier, but the advantage is that they can mobilize deposits. They wanted to reduce the cost of funds, and therefore that provides an opportunity for them, and that microfinance activity of them continues to be the main share of their balance sheet, and they continue with that. And there was some problems in microfinance industry. In case of microfinance, when it started as a very noble cause for lending to the rural sector, weaker section. It started in a very, very nice way. But slowly they found that it became a source for making huge income, so much so, you will be surprised. Many of the overseas venture capitalists started taking shares, holding in these microfinance companies. They found that repayment rate was quite good, the tickets were very small, the risk was very well distributed, and they could charge any amount. There was no restriction on that, and they started charging any amount of interest, and this became a big problem, and slowly the murmuring started. One of the company which in Andhra, when they floated in equity, people were surprised how a microfinance company's share can be having so much premium. It started such a huge debate and discuss, and it became a political issue. I don't want to go and get into what exactly, and the government intervened, and that crippled that MFIs. And that cannot be allowed, and Reserve Bank stepped in and appointed a committee, and they brought specific regulation for MFIs. Basically, the regulation which brought out looked at customer service. What they said was, first thing they brought in an element of interest rate regulation for MFIs. Second thing, they said what is the maximum amount of loan that you can give. Third is simultaneously how many loans you can give to them, and how many microfinance can at the same time finance them. In other words, microfinance companies started giving more and more loans to make them debt burden, keep getting the interest and rollover. This Reserve Bank cut it by saying that it must be need-based, it cannot be more than 2 institutions, not more than 2 loans, and the ceiling was kept. And another thing they said was, if you are going to give a loan, if it is more than a particular amount, then the number of the period you will allow for them to recovery will be longer. So they created a very congenial environment for the small borrowers to borrow conveniently and without any stress or burden on their cash flows. Now, this is a very big achievement by the non-banking finance companies. They still survived, and they did so very well. The number of microfinance companies increased, and many of them now become small banks. And the small banks are meant for mainly the focus is on financial inclusion supporting. So therefore, the NBFCs are migrated from purely speculative deposit taking and profiting and taking risky ventures to an organized, regulated domain. And this service of them is so important that they occupy a major segment of the financial system. But recognizing that they are growing so much and interacting with the different segments of the financial system, Reserve Bank wanted them to be financially sound, and the regulations are in place, which is constant. Now slowly they are enhancing the regulation so that it becomes almost at par with that of the commercial banks, with the lighter aspects being retained. So this is a sum and substance of the non-banking finance companies with the focus on microfinance. Even today, there are a number of microfinance companies which are running very profitably. There was a problem, I don't want to know or say what reason, in the past 1.5 years. 1 year, they had a problem on cash, and many of them suffered, recovery suffered. Now, slowly many of them have overcome, and they started making the balance sheet black, and they have started reviving. So basically, what I would like to see, when we talk about financial inclusion, these non-banking finance companies are a very important component of this thought. Here I stop it and I will leave it to. Thank you.